It's Friday. This Friday feels particularly war battered. I feel like this month feels particularly war battered. This is Risk and Rewards. John Authers. I'm Lisa Abramowicz. And this week, the question became, how hawkish have we gotten? And perhaps have we gotten to a point where we've reached a crossroads where basically we're pricing in, 5 rate hikes right now by the Federal Reserve this year. And we're also expecting that they will not necessarily break the market or break the economy. And is there a dissonance here? And I think that that's the question. Can the Fed orchestrate a soft landing?
That's the question, yes. And the flattening of the yield curve, sorry to get into such technical language so quickly, but the fact that 2-year yields have risen quite so fast while longer yields, 10-year yields, have actually fallen, which is unusual, really does quite strongly imply that the market thinks we are going to break something. That we'll get our 5 interest rate hikes in this year and maybe 1 or 2 more at most. But at that point, somehow or other, we are not going to need to go further than that, which does imply that things will have gone wrong. I suppose there's a positive take you could make on this, which is that there is a belief that by moving faster, while still having a much lower terminal rate than the Fed itself thinks, you're going to deal with inflation nicely and swiftly that way, and then you can stop hiking rates. That, I suppose, would be the positive way of making sense where we are. I still find it very hard to imagine you're going to beat inflation with the Fed funds rate still significantly below the rate of inflation, which is what we seem to be expecting.
Well, I guess that what people point to, what's the transmission mechanism if it's not markets, if it's not necessarily materially higher borrowing costs and an all-in basis for corporations or individuals? How do we achieve some sort of effect on inflation? And people point to expectations. And we got that University of Michigan survey, which came out and actually showed sentiment falling to the lowest going back to November 2011, people saying that inflation was a massive problem right now, in addition to concerns about Omicron. But within that, what's interesting is that the longer term inflation expectations did not go down.
Yes,
so they barely moved. So, the short term and longer term inflation expectations stayed where they were. So this isn't bringing down inflation expectations. And in fact, not only has the Fed not successfully done that yet, of course, they haven't made a move and are still expanding the balance sheet. But, it seems as though people are already perhaps restricting their purchases as a result of this, which is exactly what the Fed doesn't want to see. So, they're looking at this and how do you tell consumers, we've got your back, we're on this, without causing a market disruption that has pernicious ramifications?
Well, are you implying that I might be able to answer that question?
Yeah, please answer this. John Authers.
I'm not sure there is an answer to it. That is exactly where we are. I think something probably breaks if you get to a situation where you have this amount of money that's been let loose on the economy and where inflation is this high. It's not realistic to get back to where we'd like to be without something somewhere along the line going wrong. Now, you can let inflation stay higher for longer and deal with the other things. You can make sure you've got inflation under control and have a worse fall for the economy and so on. There are plenty of very interesting trade-offs that economists and elected politicians can make. And it's a fascinating job for the market trying to work out what's going to result. But something has to give. And it's only natural that something would have to give, given the scale of the shock that COVID gave the economy.
We'll get into what the potential breaking could look like, because I have a couple of ideas or questions about how this is going to go down that are different than in the past. But I do want to bring up oil as also exacerbating some of the inflationary pressures. And the Fed usually looks past oil as something that is a passing fad. And OPEC Plus may come out and try to bring prices down because they don't want things to be this hot. They don't want the high price to actually destruct demand going forward. However, given the Ukrainian conflict with Russia, given some of the concerns that Europe has been having, and everything from weather to the transition and the lack of investment in certain facilities.
Yes.
How much does this add to the inflation expectations akin to what we saw in the 1970s? I'm not comparing the two time frames, but it was stickier if it stuck around for a longer time.
Yes. No, the longer, there's very good historical evidence on this. The longer some of those innately more transitory things, food prices, fuel prices, stay higher, the more expectations across the range of goods will tend to rise. Everything will get stickier. I think when it comes to the Ukrainian situation, it's obviously a fascinating political problem for Biden and the administration to judge, because they don't want to look weak, but they also presumably know that it must make life much harder for them bringing inflation under control if they do go through with being aggressive in terms of sanctions on Russia. I do think when it comes to the Fed, one of the worst monetary policy errors of recent years, which is easy to forget because it came in the middle of 2008, was Trichet actually hiking rates in the summer of 2008 when the credit crisis was already going, because the oil price was so high. I think there was a now forgotten huge oil spike in the summer of 2008 that helped central banks, helped everybody take their eye off the critical problem that was about to burst out. I think the general message is, yes, you should, as a central banker, not take too much concern about oil in itself. I guess the only other thing, though, that it is important to mention is a lot of the more bullish forecasts, the forecasts that inflation does come down in the next few months, are based on the idea that the base effects of the oil price rise from 12 months ago will start to turn negative for inflation. And if oil keeps making new highs, that cannot happen. So that is in terms of the optics for the public, that's a very serious problem in terms of forming expectations.
Okay, hear me out, because this is just a hypothesis and I'm playing through it and thinking out loud.
Yeah.
But one way that oil prices lead into something potentially breaking is, how much do higher oil prices accelerate a global tightening cycle? How much does it not just force the Fed's hand because it keeps the consumer continuing to worry about inflation and they want to really address the expectations, but push the hand of the ECB, push the hand of the Bank of England? How much do we start to see this featuring into that discussion? And then the global tightening has a sort of magnifying effect that feeds into the markets that the Fed is most concerned about, which really is the credit market, which so far has been relatively insulated and has been calm. I mean, yes, you've seen yields rise. Yes, they've sold off, but it has not been disorderly. How much is that the trigger, the momentum of that global tightening cycle, reducing international demand for some of the corporate debt issued out of the United States, that suddenly leads to an aha moment of, wait a second, have we gone too far? And then at that point, what happens?
Well, it's the tipping point moment, or the moment the coyote looks down after walking off the cliff. All the various analogies that are out there. I do think, trying to be optimistic, because people complain that I'm not optimistic enough.
You think I took us too much down a gloom scenario, a spiral?
One big difference with the 70s is oil. You're right. A high oil price is ultimately deflationary. It acts as like an extra tax on people. It is a weight on the economy. We are a much less oil-intensive economy in the world in general, and particularly in the West, than we were in the 70s. You need to burn much less oil. Obviously, we don't discuss ESG very much on this space. Obviously, there's arguments that we should reduce it still further, but the economy is much less oil dependent. And so that is the key reason where we are different from the 1970s, that we are not quite so utterly beholden to a big rise in the oil price. So there is, getting that off my chest first, that this is the key reason we have good reason. We can hope and assume that we're not going to repeat the 70s, because just oil just isn't as important as that anymore. Other than that, I agreed with absolutely everything you said. I mean, where we are with oil at the moment, and particularly if the situation in Ukraine pans out towards the worse end of what looks possible at the moment, then yes, you would get a baby 70s. That will have a very sharp effect on the oil price, and perhaps also for Europe, just the sheer supply of energy, and that gets you into this. I mean, again, it's a childhood memory for me, but the dynamic of needing to get ration books and having to stock up on candles in case there were power cuts, which that really does have an immense effect on confidence generally if it happens, and it's plainly not good for the economy. So very long-winded answer short. I completely agree with you, but I would at least like to get it off my chest that at least it's not going to be. It would be significantly less bad than the 70s, because oil is significantly less important than it used to be.
Sure. There are a lot of other dynamics too. Yeah. I mean, in the 1970s, real wages were actually increasing. There were a whole host of other things. And right now they're not increasing, which is not particularly great. But, George Saravelos over at Deutsche Bank talked about how people's rate hike expectations, or where the rate would be in 10 years, the Fed funds rate, is now 100 basis points lower than it was 2 years ago.
Yes, I saw that note. That's terrifying.
It was terrifying. Right? It was a terrifying note, basically saying, this is not healthy. This isn't great. Basically, we're not saying that everything is so amazing. We're just saying that we took all the inflation and parked it in 1 year and brought it forward. And then we're going to go back to that slow grind. And how do we get out of this? And the idea of the Fed, do you just hike aggressively into that? Is it too late to really even be an influence on that? I mean, I was really struggling with that note. What did you make of it?
I mean, George, he's a very, very interesting guy who has had some, who has had some takes that even I would regard as negative in the last few months. But there's a range of views. What he's plumbing there is, I think, the sheer difficulty of reconciling the different strands we have at the moment. The other thing, it's fascinating. Market expectations are so much lower than the Fed's own expectations for the terminal rate. That's the thing that continues not to change. The Fed still thinks, and I guess, again, this is more of an optimistic take than anything else. If you think there's more inflation, you actually might also think there's more activity in the economy. The Fed thinks we're heading for 2.5–3%, and the market still thinks we stop at 1.75. Which implies barely doing anything more after this year. Yes, sorry.
No. I was just going to ask you, in the minutes that we have left, what do you think is the likely risk or reward right now? The sort of trade that is a bit contrarian, but that feels more likely than not.
It's not really contrarian at the moment to be pro-value, but I think the value trade probably has an extremely long way to go. As I do broadly believe that we are going to, that we do have inflation returning, that we're into a higher inflationary regime, I would say emerging markets become an interesting possibility. Which I can scarcely believe myself saying, but if you look, emerging markets have actually held up quite well in the last month. They may have come about as far as they can, and many of them benefit from higher resource prices and so on. We might actually have finally got to the point where there really is value there. One other thing that does just occur to me, on a day when the Fed terrifies everybody, gold went down a lot. I think the upside, there's an asymmetry between the potential upside and downside of buying some gold when inflation is high and people aren't buying gold yet. Maybe that's a sensible thing to have at the side of a portfolio.
That makes a lot of sense. I mean, basically, if it goes back to correlation, I'll just say that The one thing that keeps standing out to me is a number of investors keep saying they're going into 2-year bonds, and that basically how much more hawkish can the expectations get? And worst case scenario, you have the flexibility to go and cash out since it's short term and use that cash to buy something if there's a huge disruption that you see that you can take advantage of. And I understand the thinking of the lack of predictability and the desire to get yields that are not that far away from long duration bonds right now. So I understand the idea behind that, and it makes sense to me. I mean, honestly, though, this is a confusing economy and a confusing market.
I'm going to grab one last word. Shall I tell you what that reminds me of is the number of people who are saying we've now absolutely set ourselves up for Powell to give us a nice little dovish olive branch to walk us back a little. And judging by the way the market reacted, a lot of people did truly believe that. So maybe there's something similar to the idea of the people piling into 2 years. It's just people have done their reverse psychology a bit too many times and might have output themselves.
Someone said this week on Bloomberg Surveillance, you know, I'm not going to put Powell on a couch. I think that he's probably had, his share of therapy.
I would need to be on a couch if I had his job for very long.
I think I would.
Yes.
I think I would too. Well, that does it for us today. Have a wonderful weekend, John, and stay safe in this snow squall or whatever they're going to call it.